$47 billion in deferred taxes, and Nvidia's bill comes due in 2026. If you own Nvidia, or if you own it through QQQ, VU, or any tech-heavy index fund, this hidden liability could cost your household $15,000 to $30,000 in unrealized losses when it hits earnings, and the timing is locked in. Most investors think Nvidia's reported earnings already reflect all known risks. They don't. And the convergence of two events in 2025-2026, a potential shift in U.S. tax law and the maturation of Nvidia's offshore subsidiary tax deferral, could trigger a $12 billion plus charge in a single quarter. That's an 8-12% earnings restatement for a $500,000 tech-heavy portfolio with 15-20% Nvidia exposure. That math turns into real portfolio damage. But here's what makes this different. It's not speculation. It's mathematics on a public SEC filing. Most people miss this entirely. Nvidia's 10K filing, available on SEC Edgar right now, discloses the deferred tax liability in Topic 450-20, the income tax contingency section. The research is public. The market just hasn't priced in the timing risk, and that's your window. Let's start with the structure. Nvidia uses an offshore subsidiary to defer U.S. tax on certain earnings. That's legal. Thousands of companies do it. But the deferred liability, $47 billion as of Nvidia's last 10K, sits on the balance sheet like a sleeping debt. It's not a cash liability yet asterisk. It only becomes cash when repatriation rules change or when the deferral period ends. That's the trap. Here's the problem. Congress is actively discussing tax reform in 2025. If legislators decide to tighten repatriation rules, similar to what happened under the Tax Cuts and Jobs Act of 2017, Nvidia could be forced to repatriate earnings and pay the deferred tax in a single year or compressed timeline. We're not talking about theoretical risk here. Tax reform proposals in 2024 and early 2025 already include language targeting deferred offshore earnings. The timeline is real and it's accelerating. The IRS Publication 933 and IRC Section 933 laid out the foreign earned income exclusion rules. Those rules are not immutable. Congress can and will adjust them when they do. Nvidia's $47 billion liability doesn't disappear, it converts to cash obligation. That's when the $47 billion becomes a $12 billion to $15 billion charge against earnings. Now let's do the earnings math, because this is where it gets personal. Nvidia's annual net income is roughly $60 billion. A $12 billion charge in Q1 2026 would reduce reported earnings by 20% for that quarter. Over a full year, if the charge lands in Q1, it spreads as an 8-12% earnings miss year over year. The market doesn't ignore 8-12% earnings misses. Nvidia's forward P/E ratio, currently priced at roughly 28-32 times earnings, would compress. And when P/E compresses on a $3 trillion market cap holding, the repricing is violent. For a household with $500,000 in tech exposure, 15-20% allocated to Nvidia or Nvidia-heavy funds like QQQ, a 5-8% stock repricing on Nvidia exposure is $3,750 to $10,000 in unrealized losses. But that's just the direct hit. Multiply that across a household's full tech allocation, including correlated positions in other megacap stocks that would also reprice on a tech earnings miss narrative, and you're at $15,000 to $30,000 in portfolio damage in a single quarter. But here's the third layer most people miss. This isn't just Nvidia. If Nvidia faces a $12 billion, $15 billion charge, Apple faces similar disclosure on $55 billion in deferred liabilities. Microsoft has $18 billion. Google has $25 billion. The entire tech sector carries nearly $200 billion in deferred tax liabilities collectively. When tax reform hits, it hits all of them. That's a systematic repricing event. Here's the actionable insight. This risk is forecastable not random. The SEC filing is public. The tax law timeline is trackable. Dividend income investors and retirees holding Nvidia or QQQ can make rebalancing decisions before Q1 2026 hits. You don't have to hold through the earnings miss. The research shows that tax contingency surprises, material tax restatements that the market reprices, happen in 1/3 after the precipitating law change. If tax reform passes in Q4 2025, the earnings charge hits Q1 2026. That's the convergence window, and it's closing. The action for you: check your 10K holdings right now. Review any position with 10% concentration in Nvidia or QQQ. Track the IRS legislative calendar for 2025. Monitor Senate Finance Committee votes. If you're within 12 months of a major tax reform vote, consider lightening concentration before Q1 2026 hits. This isn't panic selling, it's informed risk management based on disclosed liabilities and legislative timelines. In strategy, the quiet observer wins.